Hey everyone, it's Doug the Retirement Guy, and yes, you guessed it. Here it is, the daily paid dividends. Yes, it's cash every single day. We knew this would be coming. We didn't know how they were going to put this program together. We didn't know who was going to be the one to make the stab at it. But we have been notified. We've gotten all the information behind the scenes about this. You can't even say it's a new, but a change in a fund that is going to give you cash every single day. They're going to compound faster, and they're going to help you try to get to that financial freedom, which is more cash, less stress. And we're going to explain it today, what's happening, where it's coming from, and honestly, should you buy it or not buy it? And I'm just going to give you my own personal opinion on the buying or not buying. So let's get into today's video. Well, right off the bat, I do this. Past performances does not guarantee future results. The information provided in this video is for educational and informational purposes only. If you are looking to do financial advice, always contact a financial advisor. As I am not a financial advisor, I am just someone who has been heavily into all of the retirements and working with the money. Well, strive, invest in the excellence is their motto. The next evolution in income investing is called SATA, SATA. Okay, it's going to get you where you're getting paid daily, and they're already saying that they're looking at a dividend payout about 13% yield over 12 months. Now, what if you're paid? This is their sales pitch. I'm going to tell you. What if the portfolio paid you before you finished your morning coffee? The experience a revolutionary model designed to deliver consistent cash flow every single business day. So that's telling us that we're going to have that frequency about 250 times a year. They're going to target a 13% APR, and they're going to give you about 5.42 cents per share per day. Now, so far the numbers look great. The questions that we're going to have is where is that 5.42 cents coming from? What are they investing in? What are they doing? Well, I'm going to explain that to you today. But first off, Strive Asset Management is a company that's been out there, has done some great things with different products, but they're not really promoting huge. So I think part of this is a good promotional piece to get people attention to Strive and how they're trying to get into that marketplace. Now, the timeline of the dividend frequency, I'm going to start here. And this is kind of just giving you a little bit of case history of what's going on. When originally dividends were coming out, when I call it in the Stone Age, we might as well call it, we had quarterly payments, and then we moved to monthly payments. So you're looking between 4 to 12 payouts per year. Then, just realistically, less than maybe 2 years ago, we started the first ever weekly payouts. And we got the round hills and we got the yield maxes, which are the kings of those type of funds. Where we're over, I want to say we're over 165 different ETF funds now that have weekly payouts, so 52 times a year. Then the big one came out was Defiance. Defiance said, hey, look, we're going to take this serious. We're going to do the NASDAQ 100 lightning spread, the QLDY, and they're paying twice a week for 104 payouts a year. And now Strive is coming out with SATA, SATA, and they're going to do a everyday business payout 250 times per year. Now, the key insight of this one, dividend payout frequency has accelerated by 20 times in just a few years, shattering that traditional quarterly model. The question again comes out, and I know I'm throwing a lot of questions that we're not answering, but the question is, do you really need payout every single day? Do you really need it twice a week? I know weeklies were fun, but there was so much NAV erosion and things we had to worry about that it didn't make it fun. That's why you see a lot of things shifting back to, or at least my portfolios are seeing shifting heavily into the monthlies. Pay me once a month, I'm good. I can learn how to balance my budget. I can balance everything out and it works fine. These other three, are they, there are some profitable ones in weeklies. I'm not saying that because we do have our challenge that we do, and we've shown that there is some potential there. And we've done some things on the QLDY, but do you really actually need that? So again, is that a marketing or ploy or not? So let's really sit down and let's meet what is SATA? What is this thing all about? This is what they've gotten very serious with. They've actually already trademarked the Daily Dividend Company. So right off the bat, I don't think this is only going to be a one and done type situation. I expect them to be building out an entire portfolio or entire layout of different daily dividend companies. Now, Strive Asset Management is a leading asset manager focused on maximizing value through their excellence. Their official trademark is the Daily Dividend Company. It's a legally protected brand identifying and representing a commitment to the daily income. Now, SATA is not a new fund. STA has actually been out there for a little bit of time. It's a tradable of major exchanges as a highly liquid preferred equity investment. I'm going to say it here, and you're going to come back a little bit later in the presentation. I'm going to tell you up front, this is not an ETF. Okay? This is not an ETF. I almost want to tell you it's more like a glorified money market fund. Now, they may not like me saying that, but I'm trying to put it in the terms that everyone can understand. This is not ETF. I'll say that up front. The real income of daily dividends, aiming to be the defiant name in the daily income investing, providing unmatched payout frequency. So, like I said, they have really they've put this together. They're not just doing this as I'll call it the fluke, but they are getting attention to themselves and what they will do down the road. So the Daily Dividend Company, SATI, is a publicly traded liquid preferred equity investment. Okay? The current 13% APR monthly dividend schedule for SATI will translate into a 13% paid every single day starting June 16th of 2026. So realistically, we are probably 2 weeks away from their first dividend payout under the daily process. So they're going to increase the dividend frequency from 12 payments per year to approximately 250. I want you to know, SATA is already out there. It's been out there. Okay, it's been paying a monthly dividend. So this, again, is nothing brand new. They've been doing it. They're just switching from monthly to daily. They strive is the targets a $99 to $101 trading range, okay, for SATA to minimize the volatility of the security market. The company currently holds 18 months of cash and marketable securities in reserve for dividend payments and also holds 15,000 Bitcoin, which when combined with the reserves gives the company the ability to cover the dividend payments for well over 20 years. So we break that down. They're pretty much telling you their target price is going to be that $99 to $101. So this falls right into as this is kind of like a security of as the economy. What happens in the economy? Things go up, things go down. We have volatility working around. This is where bonds, T-bills, and all that come into play. These guys are trying to show you an area to invest into that works similar to the T-bonds and the bonds. And they're showing you that they have the securities already in place to continue for 20 years of paying dividends. So, it's trying to kill that any NAV erosion type idea or anything like that. But it also says we're not going to have the big growth. Okay, this is more of income versus trying to achieve a growth. Because I looked at just before doing this, the price of the fund was still about $100 per share. And that's what they're going to try. They try to keep it at that with what they do with the Bitcoin. Bitcoin I don't think is a bad thing. It's came down kind of, I always call it, found another ledge for it to sit on. If it grows, it's not attached to a point to the economy, but if that starts to grow a little bit with the uncertainties, then the value, you're going to get more value into the fund again. The dividends paid by SAT are classified as return of capital, which means they are tax deferred for the U.S. investors. SATA is a part of a fast-growing sector of income assets called digital credits, where the company offers a liquid instrument designed to trade with a minimal volatility while the company underwrites Bitcoin risks. So here's where it really gets into the long-term version to tell you what they actually are. They are a underwriter of Bitcoin. So everything you're dealing here is more involved into Bitcoin. So if you are a Bitcoin player, this is probably up your alley. If you are not, if you don't want any part of Bitcoin, this is not for you. Okay? This is not for you to be a part of. I always clarify that up front. This is also nothing that you're going to invest in to expect to get big growth out of it, because where they're really getting it, they're underwriting Bitcoin. That's where they're generating income from, is doing the underwriting. So interested investors can purchase SATA at the brokerage of their choice today. It's been out there. It's been out there for a while. So combination, do they have money to do this? Yes, they do. They are actually zero debt. They have zero debt at all on this particular fund. They are sitting fine with it. They have over 20 years to be able to pay out dividends, but they're also generating income from the underwriting of Bitcoin across the board. So by the numbers, how realistically is this? 13% annual. It's what it's paying out today. The only difference that this fund's doing is going from monthly to daily. Okay? Now, is there a big change in doing daily? Sure. You're getting, and I'm going to talk some stupid numbers here, but you're going to talk 5 cents a day. Okay? So you're getting 5 cents every day, and if all of a sudden you start putting that into either dripping it back into it or putting it just into a standard savings account, which I don't know why you would, but putting it in, you got some, basically you're slowly working your money back up, okay, to grow it even more. So it's just getting your money to you a lot quicker and sooner, just a smaller piece of it across the board. Now remember, in the transition, June 16th is when they're going to go live with the historic dividend payout. They already have the schedule out. Seeking Alpha has it. My stock analysis, if you're not part of that, I'll have a link down below, give you a discount if you want to get into stock alpha, or excuse me, into stock analysis. That's always available. But does your current savings account compare to a 13% targeted yield? Because this is what they're trying to do, guys. They're trying to come after your money market funds, your savings accounts. This is where the money to park your waiting money, your holding money, to park it on the sidelines. I don't think they're sitting here thinking that they're going to get $1 billion of net assets out there. Not everybody is going to pour all their money in just to get a daily payout of 13%. I think what they're trying to tell you is, look it, you have a lot of money in the money market just sitting there waiting to do something with. Instead of getting the 4%, 3%, 5%, whatever the number currently is in your particular fund, we're telling you can put the money over here and get 13%. And we're going to pay you daily. So, if you're only in it for a week, if you're only in it for a month, or if you're only in it for half a year, you're still getting, a bigger portion of it on a daily basis versus just waiting for 1 month. So it's kind of an interesting strategy that they've used. I pulled up already what they've already expected, and like I said here, April, I'm going to start at the bottom. April, they paid out $1.06 monthly for their dividend. May, they came out $1.08. They expect to do $1.08 in June, and then they're going to 5 cents across the board. So already they're telling you what they're putting out there. They've already done their declarations. They've already said this is already set. This is what we're going to pay. Here's the record dates, and everything's in place. That you can see, exactly the record date, then their payment date. So it's just going to constantly hit ding, 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 ding on your account. Just boom, 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 5 cents a day, 5 cents a day for every share. So overall, I could have shortened it up, showed you what they've done in the past, but pretty much it's been that same thing, about $1 across the board. So again, I'm going to explain here. What exactly is SATA? Well, it's a publicly traded asset. Okay, SAT is a publicly traded instrument available to the open markets, offering the ease and entry and exit as a traditional stock or an ETF is. But remember, I want to tell you, this is not an ETF. I got to clarify that. I may say it throughout this show, but it's all pure accident. This is not an ETF. This is more of I'll just put it in their own words. It is a publicly traded instrument in the open market that you can put money into, take money out, sell it in, sell it out. Like you do a stock. I can buy a stock at 9:30 this morning, and at 10:30 I decide I want to sell it. I'll put it out there, and I can get value for it instantly. Okay. But this is not an ETF where they're taking your money and reinvesting it into other pieces that they're not buying an under asset that you're saying, oh, I'm going to invest into this, and they're going to invest into Nvidia and Apple and Google, and if those things go up, the value is going to go up. No, this is kind of a holding spot for your money. The structure as a preferred equity investment, it captures consistent income streams typically reserved for the higher tier institutional investors. So this is what I'm trying to tell you, is this is where, the big institutions always have money to park it on the side, and that's where you see, we've covered this on many times on the channel, of that you'll see T-bills out there, you'll see government investments. It's holding spots that people can take that money, use it accordingly. You take a look at any ETF out there, and you'll see that they have money sitting on the sidelines, and they always have it in government regulated, the T-bills or bonds or anything like that they have, so that they allow that big money to be, the government to do what they want to do, and keep it funding, and they collect that 4 or 5% interest off of that money. This is the same thing here, just making it open to the average Joe. Now, the asset is specifically engineered for the ultra high frequency payout model. It's designed to handle the approximate 250 distributions per year. That gives you that cash flow. They optimized to combine the high liquidity of common stocks with the reliability of high yield income consistency of preferred shares. Now, SAT is built to bridge the gap between market liquidity and institutional grade cash flow, giving you daily pace. Now, let me just give you some highlights from the presentation that they did give to us when they introduced this. And Strive right now has zero debt. This is the big thing that they presented at the meeting, that they had zero debt. The Strive is the first publicly traded company with a Bitcoin backed that really is zero debt onto it. They're really preferred, and only amplification balance sheet is that they're really sitting there saying we're debt free, we owe nothing, we're positive across the board. So it was a big positive for that one. Then we got into their step of their higher income fluctuation, the 13% yield versus money market, SCHD, anything where you're really just sitting and parking long-term capital that they said. Um, and they also said we can also look at short-term capital as well. But this is where people are holding money and are saying that STA is really a place to park money. Getting that 13% annual yield, it just, it is almost double what the next closest one is, and that is just the high yield categories, and then the preferred at 6.4 and 6.3, getting SDATA at 13%. Money markets basically averaging about 3.9, T-bills about 3.6, and the dividend from SCHD is 3.3. So while I was listening to all this, I started questioning and saying, are you really putting this that you should put money into, instead of SCHD, should you put money into STA for income? But there's no growth. So we're going to talk about that in a little bit here too. So the annual income on $1 million, if you took $1 million put into it, now this was just simple math, and I kind of sat there and said, what are you guys trying to promote or sell here? And that was 13% of $1 million, $130,000 a year. 64,000 if you had it in bonds, 63 if you had it in preferred stocks, 33,000 if you had it in SCHD, which is all fine and dandy. But again, I asked that same question: is if I put money in SCHD, there's growth into it. We're going to take that $1 million and we're going to be maybe $1 million. I'm just making up a number now, $1.1 million, $1.2 million, whatever that number comes into. But you're only getting the income. So I understand what they're trying to say, how their interest rate is definitely higher. If I had T-bills, money market, but there's still high, there's still risk, okay? I don't think there's much risk in the money market or the T-bills, but there's going to be definitely some more risk versus value. Then this is where they really got into the whole money side of things, compounding. So when they sat down, they did their math, they explained it to us, and now I understand compounding, but this was a great way I wanted to share with you too, is how they promoted this to show us that doing an annual 13% is 13%. If you do semi-annual, you're actually getting your APY, which is your total yield off of this at 13.42, quarterly at 13.64, because the money, you're starting to make money on top of money. And what they started showing is that the difference between monthly, 13.8, to weekly is 13.86, to daily is 13.87, which, again, I'm not trying to be Mr. Negative. I really want to make sure this doesn't come off this way. But I want to make sure I open up to all of our viewers and all of our subscribers to make sure you guys are following what I'm seeing and what's going on. We're picking up, just because you went to daily, we're picking up 1/100th of a percentage point. Think about that. We're only picking up 1/100th of a percentage point from a weekly, and we're picking up 7/100ths of a monthly. It's not that big of a difference going from a monthly to a daily. Okay, there is a slight little amount, but if we're picking up pennies and nickels and dimes right now, the question is, what's the risk factor on top of it? So the transition is going to happen this way. The current state, they're 12 payments per year. They're on monthly. They're already at the targeted 13%. The evolution will go to 250, doing dailies to pick up a little bit more interest for yourself. So the critical question here, I really have to put this is the analyzes the stability and the underlying asset, the risk profiles to help investors evaluate the variable of that 13% daily. I really question this, the operational, how sustainable is the daily payout mechanism? Well, they've already said that they have 20 years to make those payments without any worry. But I really want to know is, doing this, Are we going to see a drop off every day of the price? Is it going to have time to recover? Am I thinking that this is more dividend driven than it's, accordingly? The underlying asset, what assets generate the consistent 13% of these payouts? Now, the income capture strategy is optimized by the high yield consistency and the diversification across that single asset, this default risk. And then the other one is, what's the overall risk profile of the program? Where's it all come into? There's a lot of questions with this. We're going to do a deeper dive. I already said we need to do a deeper dive in SATA, but I wanted to get this out here saying that they are switching to the weekly to find out really how does SATA really work? How does it go across it? I understand. Again, not an ETF. This is more of a holding of the money. We're not looking for growth. The price is going to be about, it's almost like, think of it again, buying a T-bill. That's going to be, you're buying it at $99 or $100 or $101, somewhere in that factor. And when you go to sell it, it's going to be worth $99, $100, or $101, depending on which day it is. It's going to be that. So there's really, I'm going to say, zero growth. But when I'm looking at this as a whole, this bigger picture is you're getting a 13% return on your money versus just sitting there getting a 6 or 7%. So if someone has some big cash they want to sit, this would be probably great in a probably like the foundation bucket that I use, or if you got idle cash that you're sitting with, putting it onto this. Is the only way I can see this actually working. I would not put this as saying this is my full income side of it, 13%, even though it's going to be higher, but there's no growth. There's nothing to make up for any type of a loss or any type of inflation. So so you got to take that out of it. So realistically, once you take out inflation, we're probably down to a 10% deal. That's why I still will stick with my covered calls in the income section. Growth section, if I took and rolled the 13 into it, I already said there is no growth, so the 13 is your growth. That's why I say maybe more of a foundation mode that you're holding idle cash in. Things that maybe a T-bill only getting 3%, maybe you need to look to put some of it into this fund as well. Guys, that's what we got today for you. That's what's happening with SATA. Let me know what your thoughts are. I know it sounds like, what really is it? How is it going? But it's really a strong holding for Bitcoin. And if you're not excited about Bitcoin, definitely not a place to be. Let me know in the comments below. Kind of interesting the way the world is changing. Love to hear from you. Thanks for watching.
Thank you for watching.